So the recording started. Before we begin, in the chat, either on Facebook or on Zoom, you have access to the exact document that we're going to be touching on today. All right. So don't you worry. If you want to follow along, you have everything in the world that you need to be able to do so. So that's spectacular. Okay. So just, send me a message either or on Facebook to let me know, hey, I don't have the document or whatever. It's right there and I'll be more than happy to send it to you. So first thing first, in terms of what you have available to you in terms of content. Now, this is for free, okay? If you go on my website, all right, ismahelps.com, /COMM308, you're going to find a bunch of practice problems, a bunch of notes, and you'll have a lot of stuff that you'll be able to look at if you want to study for the exam. If that doesn't work for you, you could go on our Messenger group chat, okay? Just look at, just press files, and you're going to see a bunch of documents. The most relevant one, most likely for time value of money and the following topics, will be MT1 course pack. You'll find notes, you'll find questions, and their step-by-step solutions, plus a mock exam at the end of that specific document. Now, if you want more free stuff to help you do super well on the exam, you could go on my YouTube. Now, this is like a weird, cringe plug, but if you go on my YouTube, you'll find like 20 to 30, I think, videos, pretty much all on time value of money, where I break down exam-like questions into bite-sized pieces, and we go through the solutions one by one. There's even past crash courses on it. There's like 12 or 15 hours worth of content just on this, all right? So in terms of stuff that you have available to you to do well, there's a bunch out there, so hopefully it helps. Now, oh, somebody else is joining the chat. Now, if you want more stuff, if you feel like you need some one-on-one help and blah, 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 we talk on chat all the time. So just send me a message and we'll find something, right? So you could join our future crash courses. You could do other weeklies, in the next weeks that follows, or we could do one-on-one tutoring, but that's not important. We'll talk about that, you and I. So yeah, let's get into it. So let's do just that. Let's check these things out together and let's make sense of it. So in time value of money, especially within the scope of your COMM 308 class, within the scope of an intro to finance class, there really only are 6 like important topics to understand, okay? And that's the present value and the future value, this idea of the interest rate, the effective versus the quoted rate, annuities, perpetuities, and mortgage/loans. Realistically, within these 6 topics, the most important topics, in my opinion, will begin in this order. Annuities and perpetuities. That's what you're going to see on the exam. That's what's going to be very difficult, but with the tools that I'll provide, it'll be easier to kind of like solve for. Then it's really this idea of what the heck is the effective and or the quoted rate? How do we deal with the two? How do we empower ourselves on an exam when we see that? All right, then it's present value, future value, interest rate, mortgage, and loans. The last 2, so interest rates and mortgages and loans, are super duper straightforward. There are videos on YouTube that I posted that are available to you, and I have a bunch of practice problems. It's just a question of using your financial calculator. All right, so what we're going to begin with, this just basic knowledge, and if I'm speaking too much, you just let me know in the chat and I'll stop talking about one topic that's too easy for y'all. But the first thing that I'd like to start with is the notion of present value versus future value, which in my opinion is probably the most important topic within time value of money. You really want to understand it. And we're going to try to flesh out a problem together with some sort of logic. And from there, we're going to derive the very foundation of what time value of money is all about. Okay? I'm going to ask you all to interact. So we're going to begin with present value, and we're going to mix some interest rates with this. And we're going to jump into an example, and we'll kind of have a conversation about it, okay? So let's do just that. Now, let's see if this is okay like that. And we're going to go up. Okay. So what I'm going to do is I'm going to ask y'all a question, all right? I'm going to give y'all 2 options, all right? We're going to have 2 options of an investment, option A and option B. These 2 options are going to be highlighted right here, by the way. Okay, they're highlighted right here. Option A and option B. Option A will be a payment of $500,000 today versus option B, which will be a payment of $1 million in the future in 8 years. All right. Now, just off the bat, if I have to ask you, what would you rather? Can everybody in the chat just let me know? Would you rather the 500K today, or would you rather the $1 million 8 years from now? Can somebody just, just tell me what you would want? It's subjective, right? Everybody has their own answers. But in the chat, let me know. Would you rather 500K today or $1 million 8 years from now? Whatever interest rate you believe you could get, just tell me whether you would want option A or option B. But very good answer, Waleed. I love that answer because yes, it does depend on the interest rate that you could get. But okay, so Vanessa says 500K, Marianne says 500K, Waleed says 500K, Brandon says I'm not sure. Okay, that's totally fair. And William says 500K as well. So option A. So most of us are going with option A. Me, myself, I would probably go with option A as well, and I'll tell you why. But Waleed actually brought the answer a little bit, right? It depends on the interest rate. And the interest rate is a very important topic, and we'll talk about it in just a second. But the underlying, I guess, takeaway here is that money is kind of a subjective topic, right? Depending on who you are and depending on what time you're dealing with, you may decide to go with one option versus another. And let's kind of double down on that idea. For us, $500,000 was more valuable to us today than $1 million 8 years from now. Why is that? It's because money in the future may or may not be as valuable as money today. And a very simple way to think about this is that, listen, 8 years from now, we may not be here, right? We may die. It's a very sad truth, but also we may not need the money anymore, or we may have different requirements and or specifications. And even better than that, maybe money that we're able to get today, we can make it work better and make us more money than what we could expect in the future, right? So this is just me trying to begin this conversation that money today may not be worth as much as money tomorrow, and the money tomorrow, right, in the future, may not be worth as much as the money they can receive today. Now, why is that? It's because of this idea of an interest rate. In other words, something that I like to discuss as being, I guess, the opportunity cost. We'll call it like that. So let me just kind of highlight it. Oh, I guess not. This is the opportunity cost. This is something that you'll see a lot in class, and it's going to be thrown at you throughout the whole course, right? They're going to call your opportunity cost your interest rate. And let me tell you why we call our opportunity cost our interest rate, and our interest rate the opportunity cost, and vice versa. Let me tell you this, right? Because a lot of us, we said that option A was better than option B, which is 8 years from now. But Waleed brought up this idea of the interest rate. Well, the reason why the opportunity cost is called the interest rate is because what if I told you that you could take the 500K today, but you could also invest your 500K because you have an amazing investment opportunity that's going to yield 20% per year. In that case, if you're able to yield 20% per year, that's a big amount. That means that you're essentially getting 1/5 of your money every single year. For you, it may be better off to get that 500K today. Now, I feel like I'm talking a lot, and I don't like talking a lot. So what we're going to do is we're going to throw an example at us, okay? So can somebody give me a random, all right, a random opportunity cost? Can somebody give me a K, any number, anything? It could be 5%, 10%, 1,000,000%. You decide. Can somebody just throw at us a, okay, well, Lee says 55. Geez, okay, all right. Well, let's go with 55. Why not? Why not? So what I did is if we use an opportunity cost of 55%, right, and we'll do it just for jokes, is I actually built 2 timelines that would highlight what would happen and how should we try to contextualize this idea of an interest rate and this idea of time value of money. So we went with option A, all right? And to make it more like serious, I'll go to an opportunity cost of 10%. But let's say we went with option A, and we know that we could invest anything that we have at an interest rate of 10% per year, okay? We have the opportunity to make 10% on our money per year. So let's look at that option. If we were to take option A, if we were to take 500 grand today, well, how much would that be worth for us 8 years from now? So if we look at our timeline, right? If we look at our timeline here, we notice, look at that, 500K that was taken today and invested at 10% would give us a future value 8 years from now of $1 million approximately, or $1.1 million approximately. Why is that? It's because we invested our money every single year and we took the money, the interest that we made, we added that back to our principal and we reinvested it year to year to year up until year 8. So obviously, it seems that $1,000,000, 71,794 is bigger than $1 million that we were going to expect at year 8. And for that reason, it seems like option A was the better decision. Okay. But now let me ask y'all a different question. What if our opportunity cost was 6% or even 5%? Would option A or option B be better? No pun intended. Could somebody tell me in the chat, if our opportunity cost was 5%, what option would be best? Option A or option B? So Vanessa says B. Do other people agree that perhaps option B would be a better option? Well, yeah, look at that. Because if our opportunity cost, if we only have the ability to invest our money that we receive today, i.e. 500 grand at an interest rate of 5% after 8 years, okay, which is exactly what we did, Waleed. This is essentially finding the future value for us. After 8 years, we notice that, okay, it's $738,000. So taking $1 million 8 years from now is way worth it. All right. Now, to give you more context on what we just did, what we did is that we looked at two alternatives, right? Option A versus option B. All right. And based on the interest rate, one option will be better than the other. That's really the foundation, the fundamental concept related to time value of money. But there are two ways for us to do this. And right now, I'm going to kind of build off that intuition and also throw at you an example that I want you to do. Okay. So what we did here is that we took our money that we were supposed to receive today, which was 500K. So that's our present value. And we said, okay, well, if we take our present value and we do 1 plus K to the power of N, what would be our future value? All right, that's exactly what we just did now. We found the future value of option A, which is receiving money today, and then we compounded interest to it to see whether the future value of taking option A would be bigger and or smaller than option B. Okay, is that clear to everybody that essentially we took the present value of our money, which is 500K, then we did that multiplied by 1 plus K to the power of N, and that gave us an amount. That amount we compared to the option B, which was of $1 million. And because our future value is smaller than option B, okay, because our future value is smaller than option B, then obviously it's not a good idea to go with option A. Is that clear so far for everybody? Quick yes or no in the chat, just for fun. Okay, this is a very important like intuition to understand. Okay, solid. Now that's one way of doing it. But another way for us to do this, all right, is to simply do it from a discounting interest perspective. All right. So let's say that we're considering to go with option B. We're like, okay, let's go with option B. Let's go with $1 million, but that's only happening 8 years from now. And once again, we know under the topic of time value of money, money in the future may not be worth as much as money today due to the fundamental concept of interest, of compound interest, of the opportunity cost of investing money today and getting something bigger into the future. So for us to understand, well, what is the actual value of that $1 million we are set to receive 8 years from now, we could actually discount that figure. So what we can do is we could seek the present value of $1 million by discounting it. So if you were to take $1 million, okay, and find its present value with the following formula, you would do simply $1 million divided by 1 plus K to the power of what? Can somebody write it in the chat? We do it to the power of what? What is N? Is n 0? Is n 5? Is n a million? Is n 10,000? Is n 3? Is 8? Perfect. Amazing. All right. And with that, we'd be able to find that our present value is of 676,839. Now, this is super cool because the present value of option B is bigger than option A. And for that reason, option B is better. Okay. So this is a very important topic. And to kind of tie a bow around all this is clearly, it's very obvious to us now that depending on when we are to receive money, and also depending on the interest rate that we have, our decision making related to money will be different. And that's exactly what COMM 308, what an intro to finance course tries to flesh out for you. Okay. And before we proceed, do we have any questions? Is this clear? Are we ready to kind of look at this idea of the effective periodic rate and the idea of the quoted rate? Are we good so far? Quick yes or no in the chat. Yeah, sure, no problem. Here are the two examples. There you go. Are we good so far? Do we have any questions? Do we understand time value of money? Do you understand how we could go from present value to future value and from future value to present value? Are we good so far? Amazing. Okay. So, okay, Walid, I love that question. So the present value is going to be this right here. Okay, this right here is going to be like a value, a dollar. Okay, so this could be payment. This could be a PV at a later date. And then you would put that over 1 plus k to the power of n. Once again, the reason why we're discounting a future cash flow is because, once again, we understand that $1 million, right? $1 million 8 years from now, well, for sure, it's not going to be worth the same to us today. So we're going to take that amount, we're going to divide it by 1 plus the interest rate to the power of n, okay? And that's going to give us the value of that future cash flow to us today. Once again, the reason why it's giving us the value of that future cash flow to us today is because we know that if we were to invest the same amount today at the same interest rate, we would get the same amount in the future. So let me just give y'all an example, just for fun. I'm gonna be annoying. I'm so sorry. Just one more minute. Can everybody in the chat, wow, I sound like a ghetto Twitch streamer, but can everybody in the chat just do, yeah, we're comparing the two formulas and they're literally the same thing. But can everybody just do 676,839 multiplied by 1 plus k to the power of n? Essentially, what we're doing is we're trying to find the present value, the future value of this amount. So take this amount and find the future value at year 8 for this amount. Okay? Could everybody do that to me and tell me what you get? I want the exact decimal points and everything. Okay? Everybody just do that for me. You'll see why. It's my last request before we move to interest rates. Everybody give that a shot. So 676,839 times 1 plus k to the power of 8. So we're going to compound interest to that value. And I want y'all to tell me what does that give you at period 8. And that's going to tie everything up, tie everything in together. It should kind of triangulate on what we just discussed. And after that, when you look at the recordings, you'll get to really get the aha moment, I hope, if not already. So yeah, everybody give it a shot. Use your financial calculator. Do 676,839 multiplied by 1 plus, by the way, if you want the K, my bad, it's 5%, multiplied by 1 plus 0.05 to the power of 8. So K is equal to 5%. Everybody in the chat. I need at least 3 people. Come on, at least 3. Okay, Walid has a number. I need maybe 2 more people to give it a shot, just so I see y'all are doing it. William, thank you so much. Walid, thank you so much. One last person. What did y'all get? One last person. Moichido. One last person. Okay, well, listen, I won't waste any more of your time. But obviously, Waleed and William, if we were to round that number up, we would get $1 million. Okay? We would get $1 million. And that's quite literally the idea that this formula for discounting cash flows from the future and this formula to compound interest to see how much money we would have in the future is quite literally the same thing. And it's going to bring us to the same exact answer and the same exact decision. So that's why I kind of wanted to like tie it in for you. So if you're asking yourself, why are we discounting future cash flows? Okay. The reason why we're discounting future cash flows, once again, and I'm saying it again, is because money in the future may not be worth the same as today. And that monies that we're expecting in the future, if we were to discount it, is going to give us, well, in this instance, 676,839. All right. Now, what is that number representing? Like, what does it tell us? It's telling us that if you were to invest $676,839,000 today with the same interest rate for 8 years, you would get that future value of $1 million. Hope it makes sense. Anyways, from there, we can move on to interest rates. Now, interest rates, like historically, has been something really funny to see because a lot of students tend to kind of find it a little bit difficult to wrap their mind around what this is all about. Okay. Now, I'm going to throw at y'all. I actually wrote a few things that I want to talk about when it comes to this, just because I want it to be structured. And I'm going to tell y'all why compounding matters. First and foremost, I believe at this point that we have a pretty good grasp of what compounding interest is, right? This idea that you can invest money in a continuous fashion and reinvest the interest with your principal to earn much more money than what you would have gotten if you just saved some funds or if you just accrued some simple interest. But that's not what matters. What I'd like to show y'all is a quick example. Okay, let's say, and we're going to do it together. Let's say that we had $100 that we invested today. All right, we invested today and we know we could get a 10% interest rate. All right, so 10 is our K. 10 is our K. We could call it our effective annual rate. Okay, so we know we could make 10% per year and we invested $100 today. Could somebody tell me how much interest did we make this year? Could somebody tell me how much interest did we make this year if we are making 10% per year? Could somebody tell me in the chat? How much interest are we making this year? Well, Lead says 10. I need like a few more people because this is a very easy question. If we invested $100, okay, after 1 year, if our interest rate is 10% per year, we made 10 bucks, 100%. So we made $10. We could write this right here. Give me a sec. Yeah, so we made 10 bucks. All right. So if I were to ask y'all, what is the total amount of money do we have now? How much total? What is the total amount of money that we got? Is it still 100 bucks? Is it 110 bucks? Is it 120 bucks? How much total money do we have? Principal plus interest. How much money do we got after 1 year? All right. Interest plus our principal. $10 plus $100. Thank you so much. All right. Now, y'all gonna see why I'm trying to flesh this out like this. So check it out. So we got 110 bucks after 1 year. Okay. And I guess here I'll write interest. So it's clear. And here's going to be principal plus interest. Okay. If you need like some visual cues. All right. So now if we invest that same $110 at 10%, how much interest did we make? Can somebody just take out your calculator super quickly and tell me how much interest did you make? $110 at 10%, how much interest did you make? Just write it in the chat super quickly. You'll see why this matters. Okay. Is it 11 exactly? Probably not, but it's okay. Oh, actually it is. Wow, look at that. It is 10%. You are correct. I just suck at math, believe. But exactly, it's $11. So we made $11 of interest from year 1 to year 2. Okay. We invested our money. We invested $110 and we made $11 of interest. So how much total money do we have now? What is principal plus interest? I need like 3 people to tell me what is principal plus interest. What is exactly? It's $121. Okay, so how much total money did we make? How much total money did we make? From the very beginning, from year 0 to year 2, how much total interest did we build? How much total interest? 21 bucks. Okay. Now, I believe that everybody here could agree that $21 is of course bigger than if we just made 10% on $100 every single year. In other words, that is bigger than making 10 bucks than 10 bucks, which would have been 20 bucks, right? That's obviously better. We made $21 total instead of $20 total. That's pretty darn good. Am I right? Yes, it is. So what this is telling us is that we made 21 bucks instead of 20 bucks. That's the value of compound interest, the ability to essentially reinvest the interest you made to make more money than just simply building it off simple interest, right? So far, are we good? Do we see the difference between simple interest and compound interest? Quick yes in the chat. Simple interest would have been 20 bucks of interest made after 2 years, and compound interest is 21 bucks after 2 years. So far, are we good? I'm going to assume that I say yes. Amazing. So that's the value of essentially compounding. What we did is that we had 10%, all right, 10%, and we know that we can invest that every single year. Now, I'm going to get a little bit more freaky with it, all right? I'm going to get a little bit, I'm going to get strange with it a little bit. And you're going to see why compounding really makes sense and why the formula works, okay? So let's say that now you're going to have, I'll draw it on the screen. Okay. Let's say now that you have, I guess, 5%, okay? But it's going to be compounded quarterly, all right? So we're going to have 5% and it's going to be compounded quarterly. What does that mean? That means that 4 times per year, every 3 months, you are going to compound interest. Essentially, you're going to have your principal, you're going to build some interest for 3 months, then you're going to take that total amount and reinvest it, okay? We're going to visualize that for you. So let's make this simpler for us. We know that this is happening quarterly. So we know that we're going to have essentially to have something here, something here, something here, and something here, okay? And the best way to describe what something here means is essentially we're going to distribute our 5% 4 times throughout the year. So we're going to distribute 5% into 4 times 1.25%. Okay, that's what we're saying. We're going to distribute that 4 times within the year because it is compounded quarterly every single 3 months. Okay, so this means that right here, after 3 months, you are going to build 1.25% interest on your $100. Okay, so can somebody tell me what is 1.25% of $100? Don't worry, we're going to do this step by step, and then we're going to summarize what we just did for it to make total sense. Just walk with me one by one. Yeah, so we made $1.25. I keeps on doing percentages, but that's exactly what we made. We made 1.25. So how much total money do we have, Waleed, if you want to tell me? How much total money do we have right now? It's going to be 101.25. All right. So the thing is, though, because we are compounding every single quarter, we are going to reinvest $101.25 at our interest rate of 1.25%. Okay. So if we were to do 1.25% of $101.25, how much would we have? That's the last time I'm going to ask y'all, and then I'm going to do it automatically. All right. We're going to have simply, we're going to do this times 0.0125. Now you're going to have this amount right here. All done. Okay. So notice how we made, instead of $1.25 per quarter, now we're making $1.26 per quarter, such that the total amount we have after 2 periods is now $102.52. And essentially, we're going to do this again and again. So now you would have this much, you have this much, and finally, okay. So now notice that after a year, can somebody tell me how much total interest did we make from what you're seeing on the screen? How much total interest did we make? So Waleed says 509. I need like maybe 2 people to just throw at me what you got, just so I see that we're on the same page. And don't you worry, we're gonna make more sense out of it. I just want you to walk through the example with me. And by the way, if you have questions, you can totally ask in the chat, or just say, yo, you're talking way too fast, or this is not making sense. Maybe can we look at something again? So what about William? What do you got? Like, William, how much total interest did we make from this investment after 1 year? How much total interest did we make? Right, it's going to be 105.09. Right, so we made $5.09 after 1 year, such that technically our return was literally 5.0945. That was our return. Now, everybody here has seen the famous effective rate formula. And I'm gonna throw it at you on the screen, and you'll see the relationship of what we just discussed. So give me a sec. And you'll see why this matters. So everybody has seen this formula, right? We've all seen it in the past, this idea of the effective annual rate, the effective blah, blah, blah. Or if not this version, you've probably seen something that looks a little bit more like this. I'll throw it at you. Let me get it out, and you'll see why I'm bringing this up in just a second. So you've seen something perhaps like this, maybe. I'm trying to find it. I'm trying to find a picture of the formula. I can't seem to find it. It's awkward. But the idea is that you've seen a formula that looks a little bit like this. If not, it looks something a little bit like ER is equal to 1 plus quoted rate over M, I believe, to the power of M over F minus 1. But what we just did right here is we kind of used our intuition to fabricate what it means to actually find an effective periodic rate, or find a relationship between a quoted rate and the effective periodic rate. Now, let me tell you, if you were to use a formula, what you're really doing is as follows. You're taking the quoted rate, which is always the percentage that they're going to give you. In this case, it was 5%. And then you're dividing it, right? We took 5%. We divided it by the number of payments, or the number of compounding periods within the year. Okay, the number of CY. And that gave us 1.25. Then we took that 1.25 and we said, well, okay, that 1.25% actually. And we said, all right, well, if we were to essentially use that every single period, so 4 times, what would be our total interest rate for that year? And in this case, it's exactly what we did. We took $100 and we compounded it 4 times for 4 periods within that year at that essentially periodic rate, that rate for essentially just a quarter, for essentially just 3 months. And then we found how much total money was our total return after 1 year. Okay, that's essentially what we're doing. And I feel like I'm talking a lot. I feel like I'm talking a little bit to myself. So I'm going to throw it to you guys. And I'm going to ask y'all, do we have a question? Because I'm sure you do. And maybe what's not working, and maybe where's the nuance? Do y'all have any questions? Do you guys Like, how are you feeling? Like, what's up? Where are we right now? Like, yeah, exactly. So I'll erase this and we'll do it together. So Waleed says, so this is what we did. Oh, maybe you want to do 1/4. Sorry about that. 1/4. But essentially what we did in this question is we took our quoted rate, right, which was 5%. Okay. Then we divided it by 4, such that it gives us 1.25%. Okay. So we got that. And then we took that amount. So I guess we'll do it like that. We took 1.25%. We did that times 100, which was the initial investment. And we did that 4 times. So we did that 4 times, essentially. We did that 1 plus, essentially, 1 plus 0.0125. We did that 4 times, right? Times 100. And that gave us, essentially, our total amount. That gave us 105.0945. Then we did that minus 100. And that gave us the total dollar return that we made. But what's really interesting here is that you notice how the total dollar return that we made is exactly the percentage that we need. So if we were to put it into our formula, it would be the same thing. You would simply just have 1, right? We do 5 divided by 4. And then you would probably have to do either over 4 or 1/4. I'm pretty sure it's over 4 minus 1. Don't forget that this is a percentage. And that's going to give you your return. And if that doesn't work, I could even do it with you on your calculator. So you do 5 divided by 4 divided by 100. So you get your percentage base plus 1. And you do that to the power of 4. Then you do that minus 1, and you get exactly the same answer. But yeah, so Waleed, that's amazing. That answer obviously is in decimal points. So you have to do times 100 to get your actual percentage. And what is that actual percentage, Waleed? If you do that times 100, you get 5.09, which is exactly what we just did in the example. That's why I tried to visualize. And I'm totally okay with taking another 15 minutes to talk about this more, because in the next hour, we're going to do exam-like questions together. And I took like some really hard ones too. So it's going to be super fun. So we technically have another 15 minutes if you want to, or we could take a break to talk about what the heck is an effective periodic rate versus a quoted rate and so on and so forth. So I just want to make sure that we're all on the same page. Now, do we have any other questions? Do we understand the formula? Do we understand what we're doing? How are we going? What's up? So Marianne, Vanessa, Vince, William, Yusra, Brandon, Jessica, how are we feeling? Are we feeling okay? Do we know what this is? Yeah, so the CY is a great question, William. That is for the financial calculator. And that's the second bucket that I'd like to address in just a second. So what we did here, okay, is that we noticed that our rate here, our quarterly rate is 4, right? Because we are compounding 4 times within a year. Our semi-annual rate, if we were to plug this in within our calculator or within our formula, we would put 2, right? Because we're compounding twice per year. Okay, sorry about that. I just ate food. It was like oily food, so I had to burp real quick. I'm so sorry. But essentially, what's really cool here, Waleed, is that on an exam, I think there's 2 ways to look at it. One, you could use the formula that you would plug in within your formula sheet. You are allowed a formula sheet. For the midterm, it's going to be only 1 page, but for the final, it's 2 pages. You could write that down onto your formula sheet and write an example with you, right? Or maybe 2 or 3 examples with you, so you know exactly what to do. But if that's not what you're, if that doesn't work out, if for some reason it doesn't work out on the exam, what you can do is always follow the example that we did today. Take the rate that they provide to you, right? Call it 10%, right? They're always going to give you a rate. They're going to say, hey, here's 10% compounded daily. And with that, you could just do the same little game that we did here and try to address, well, if it's compounded daily, then we need to take the quoted rate divided by the number of individual periods within the year, which is exactly what we did. And then we're just going to compound it one by one, right? So you're going to do, if I were to take my example, 10 divided by 365, right? 10% divided by 365 is going to give you, I don't know, a random number. It's going to give you X. Then you could do 1 plus X. I think that I honestly believe, Brandon, that I'd rather use the formula. I feel like the formula, it's more logical. But on the financial calculator, you can use the, if you look at right here, I believe it's right, if you can see it, there's the ICOMM function. It's somewhere here or here. I'm not sure where there. But you have the ICOMM function that you could use on your financial calculator to solve for the effective and or nominal rate. For me, it's just not my favorite way to go about it. I feel like the formula is the best way. Okay, the formula is the best way because it's intuitive. And I'm gonna try to break it down again, so that we're really sure that we're on the same page. But I'm gonna ask you all again. So far, do we want another example, or are we okay with effective periodic rates and quoted rates? So if you see this on an exam, if you see something that's related to the effective rate or the periodic rate, do you know what to do? I need to see it in the chat. Like, are you comfortable with this? You see this on an exam, you know what to do. If not, ask me your question. We still got 12 minutes to go about it. Like, why not use it? So Elise says I'm good. That's amazing. What about maybe Marianne, Jessica, Brandon? Okay, so I'm super happy then. Vince, William. Okay, so we're good. Okay, so once again, it's really important to remember that going from an effective, a quoted rate to an effective rate, or a quoted rate to an effective rate, no, quoted rate to effective, effective to quoted. The idea here is that we're just simply trying to figure out, well, how can we plug this in within our timeline, right? And from there, you're just compounding interest one by one into the future. We're going to use examples afterward to make sense of it. But it seems that we're good. It seems that we know what to do. And because of that, we're going to jump straight into some questions. Because our session is only 2 hours, I don't want to waste time with a break. And I'm going to ask you to be resilient and to, kind of deal with me for another hour and like 12 minutes. We're going to try to do as many questions as possible so you really get the most value out of this TVM kind of like session. Because next week's weekly, which will be on Thursday, 5 to 7 p.m., which will be the last weekly before the crash courses for the exam, we're going to look at equity valuation and bond valuation, okay? Okay. So let's get into it. Oh, actually, no, I have one topic that I need to talk about. I completely forgot. Thank God. So we got 12 minutes. All right. So I think that this flowchart that you're seeing on the screen, and I guess I can even structure it better. Within the scope of a COMM 308 class, within the scope of an introduction to finance class, there's really one flowchart that you want to use that's going to be a total game changer for you when solving time value of money exam questions. And it's exactly what's on the screen right now. I believe that this flowchart will literally tell you exactly which formula to use and what variables to look for and to solve for on an exam. If you didn't have this already on your cheat sheet, do it now. Really add it because it'll help you figure out every single thing you need. And it's really going to help you on your exam. And that's why it's important for you to get familiar with it right now while you're practicing 2 weeks or even, I guess, 10 days removed from the midterm. Now, this flowchart, really quickly in the chat, can everybody see it? Just a quick yes or no. Is it visible? Like, is it legible? Can we see it? Okay, cool. Amazing. So with that said, within this flowchart, we're looking at 3 key indicators, okay? Essentially, how are payments occurring? Are they occurring for a defined period of time or for an indefined period of time. In other words, are they lasting forever? That's the first sense check, okay? So we're gonna kind of highlight it together. So the first sense check is to look at our payments and decide whether these payments are happening for a defined period or for an indefined period, in infinity, a perpetual amount of time, okay? That's the first sense check. And if you look at the flowchart, I even added a little legend ahead of each boxes, or above each boxes actually. As you can see here, in this, for a defined period, if we were to go up right here, you can notice that the timeline is literally showing you a defined period of time. It's showing you T0 all the way to T5, but there are only payments for T1, T2, T3, and T4. That's in defined period. Payments that are happening at one date and finishing at another. On an exam, they will tell you, hey, payments are done then. If they tell you that, we are dealing with payments that are for a defined period, okay? But conversely, on the other hand, okay, we could look at an undefined period, okay? Now, if we look at our timeline, you can notice that we have a little infinity symbol, okay? Payments are going through our timeline. They're lasting forever, okay? So they're gonna happen at T1, T2, T3, T1 million, T infinity plus 1 million, etc. That's the first sense check that you want to do on your exam, okay? The second sense check that we need to look at, which is only really going to happen if we are actually going up right here. So if we were to say, okay, our payments are happening for a defined period, then the only real time that you're going to use this sense check is only if your payments are happening for a defined period. If they're happening for an undefined period, as you can see in the flowchart, we don't need to deal with it. I'll talk about it later. But if it is for a defined period, you want to look at two things. Well, when are these payments occurring? Okay, are they occurring at the beginning of the period or at the end of the period? That's going to be super duper important because it's going to change the way our timeline looks quite a bit, and it's going to change the type of formula and the type of time value of money topic we're dealing with. All right. So let's begin with if the payments are happening at the beginning of the period, no pun intended. So if it were to occur at the beginning of the period, you would go right here within our timeline. And as you can see, right above the little box here, you notice that our payments, they start at T0 because they're starting at the beginning of the period. They're starting today, okay? And that's really the nuance of what this is all about. And we're going to talk and address the nuance between this concept a little bit later once we get to the formulas, but still very important to understand. Now, if we're dealing with something, as you can see it on the flowchart. If we're dealing with a payment that's for a defined period of time, right? It starts at one date, it finishes at another, and it's occurring at the beginning of every single year, period, or whatever, we're dealing with an annuity due, okay? And with an annuity due, you have two formulas, PV and the FV. Use these formulas, they're in front of you, super simple. Now, on the other hand, if we were to deal with payments that are occurring at the end of the period, we would go up here within our flow charts, right? You would be on your exam, you would read the paper, and you'd be like, okay, they told us this is happening at the end of the period. So you know exactly where to go onto the flow chart. You need to go right here, okay? And notice how at T0, we have nothing. The first payment is actually happening at T1, okay? Very important to know where to put your payments across your timeline. All right, so far so good. The next step, if we were to see that payments are happening for a defined amount of time and that we know they're happening at the end of the period, the last sense check that we need is to figure out whether these payments are going to be defined, so they're going to be the same one every single year, or if they're going to be growing every single year thanks to a growth rate. In the question, they'll tell you, hey, this payment is going to increase. Notice here that we see 30, 45, 60, 75. These payments are growing by $15 every single year. So these are growing payments. And if they are growing payments, you need to deal with the growing normal annuity formula. Notice that with the growing normal annuity formula, you only have one formula to use, which is the present value formula, okay? Very important to understand that. On an exam question, if you're dealing with such a scenario, well, you only know that you can only use one formula. So use that one. On the other hand, if these payments are defined, they're going to be the same ones every single year. You're dealing with a normal annuity, and that is a present value or a future value formula. Okay. One last thing that I'd like to note before we move on to the undefined set, so the perpetuities, I would just like to tell you something super quickly. Notice how the formula for your normal annuity, let's take the present value formula. Notice how it's equal to PP0 is equal to payment over K. Oh, okay. Well, the difference between a growing normal annuity and a normal annuity is quite literally the fact that the payments are growing every single year or period. So in this case, notice how it's 30 bucks, 45 bucks, 60 bucks, 75 bucks. This is 30 bucks, 30 bucks, 30 bucks, 30 bucks. So this goes beyond the idea of compounding interest. This is still within the same realm, but the notion of having growing payments simply means that you're going to receive some payments that you're going to invest every single year, okay? But those payments that you're receiving, all right, are going to be growing by a rate, a growth rate on a year-to-year basis or on a period-to-period basis. So you want to address that. This is no longer a simple annuity where those are normal payments. So let's say $1,000. Actually, I'll give you a better example. I'll give you a really good example, and then William, I'll address what you just put into the chat. All of us are, in our degree, right? We're hoping to graduate to get a really good job. But once we get our job, obviously we're going to be super smart, people. We're going to get some money. We're going to pay, for our apartment, pay for the stuff that we want. But we're also going to save money, right? We're going to save money and invest. However, that money that you're going to invest will be literally a function of your salary. Hopefully, your salary increases every single year or like every single 2 years, 4 years, or whatever. Now, as your salary increases, right, the more you will invest by the same amount to a certain extent, by that same ratio. So that's what we call a growing set of payments. You're going to make a growing set of payments to your investments, right? To the stock market or whatever you decide to invest in. Because from your salary, you invest money. But if your salary increases by, let's say, 5% every single year, well, then your investments would also increase by 5% every single year, assuming all is constant. So that's a growing payment. That's a growing normal annuity, right? That's why we need to address this idea of that growth rate. Because when you're going to look at your future and the future value of your investment, you need to address, you need to consider, you need to compensate for the fact that those payments are going to grow every single year. Now, on the other hand, a really good example is perhaps our parents, right? Our parents are probably at the age point or at the point of their career where their salary may not increase, let's say, that they get a fixed amount and that's what they're dealing with, for the rest of their career. But they still decide to invest or to allocate funds somehow. Well, the funds that they may allocate, call it a function of their salary, will be essentially, call it 10% of their salary. But because their salary does not increase up or downwards, it does not grow or decrease every single year, their investment will be the same every single year, right? So we're dealing with a defined set of payments. We're dealing with a normal annuity. We don't need to assess any growth rates. That's the difference between growing payments and defined payments. That's the notion of the growth rate, where you're trying to address, well, obviously, if your salary, if the money that you're going to place into your investments is increasing, well, we need to account for that through our formula and through our calculator, through the growth rate, okay? That's the idea. Hopefully will lead that gave you a sort of understanding of why it's not really compounding the growth rate. The growth rate is just a function that's going to increase, the money that you're investing that will then be compounded on a year-to-year basis. So yeah, William, great question. In a normal annuity, the payments, so if we were to maybe go back into our flow chart, our payments right here, okay? Our payments, well, they're going to be the same, right? Because they're defined. So call it 30 bucks every single year for 10 years, okay? Those are defined payments, the same payments for those 10 years. They're not growing, they're not decreasing, they're not changing. That's when you're dealing with a defined payment. It's like defined, like it's definite. It's not changing anytime soon, and it will stay like that. Okay. So Last thing I'd like to address, last thing I'd like to address with the idea of the normal annuity is that if we look at the formula, payment over K times 1 minus 1 over 1 plus K to the power of N, okay? That's the formula that we have right here. So far, so good. Notice, though, that when we go back to our annuity due, we also have a very similar formula. Payment over K times 1 minus 1 over 1 plus K to the power of N. But the only difference, can somebody tell me what is the only difference between these two formulas? Can somebody tell me? You should see it. It's very visual. It's like in front of you. What is the difference between the normal annuities present value and the annuity dues present value? Could you tell me? What is the difference between the two? It's in front of you. I need a lot of people to write it in the chat. Bianca could be right. I don't know. Who knows? I need a lot of people to write it in the chat. Tell me, what is the difference between the normal annuity present value formula and the annuity due present value formula? Bianca says it's 1 plus K. More people, can you tell me what the difference is? William says yes. One more person. I guess I'll ask Waleed. Waleed, is this, what's the difference? Yeah, solid. That's the only difference between the two formulas. Notice how it's also applied to the future value formula for both scenarios. The difference is only 1 plus K. Now, I think we could all agree to this point that 1 plus K is essentially an additional compounding period, right? Remember our formula? Call it X times 1 plus K to the power of N. 1 plus K represents a compounding period. So in this case, we're telling you, hey, with your annuity due formula, okay, this could be an exam question, and it's important to understand. With an annuity due formula, you're simply compounding for 1 additional period, okay? You're simply accounting for 1 additional period of compounding interest, which is why if we go back to our timelines, notice how right here, the payment begins at t equals 0, okay? And here the payments begins at t equals 1, all right? That's essentially what this is telling us. I got you. So Marianne, I'm going to ask you a question quick. In the group chat, if you go into files, which I'll add you in, you'll see the COMM38 MT1 course pack. Within that, you have the formula sheet, literally all high definition and provided to you. Like it's very big, you'll love it. And yes, I'll add you to the group chat and the recording will be posted for everybody afterwards. But yeah, so that's the difference between, you know, the annuity due and normal annuity. Now, if we go back to our formula sheet, okay, I mean to our flow chart, notice how we talked about all the different types of annuities. Now we need to go back to our perpetuities. Once again, the sense checks that we apply to our perpetuities is, okay, are our payments happening for a defined or infinite amount of time? If it's happening for an infinite amount of time, in other words, there's no clear endpoint stated in your question, you are dealing with a perpetuity. Now, the second sense check that we usually do, which is, well, is this happening at the beginning or at the end of the period? We don't need to do for a perpetuity. Don't ask me why, we just don't do it, all right? So we get to move on to the third sense check, which is finding whether these payments are going to grow in perpetuity or are these payments going to stay the same in perpetuity, all right? So this is going to be like stated in your question. This is going to be kind of just stated in the question. Don't even worry about it. That's how it goes, all right? So with that, you have 2 types of, you know, places to go within the flowchart. And within those places to go within your flowchart, you're going to have 2 formulas, the growing perpetuity formula and the perpetuity formula, all right? Now, realistically, the perpetuity formula is super important to understand. It's PV is equal to payment over K. It's as simple as that. You're just taking the payment that you're going to receive, call it 30 bucks, and you're dividing it by the interest rate that's provided or your opportunity cost, okay? Just remember that you're dividing it by simply the percentage. So if it's $30, you're going to divide it by 5%, okay? So just remember that. It's not 1 plus K, it's just K. Now, an additional note to have, the additional note to have is that your formula for a perpetuity is going to tell you that PV0, okay, is equal to payment 1 over K, okay? In other words, you could also say that your formula is telling you that payment N is equal to, PVN, so sorry, PVN is equal to payment N plus 1, all right? That's super important to understand. And I'm going to trick you guys, and I'm going to ask y'all to give me some answers, okay? So if we know that payment is at period 3, what will be the value that we're going to put right here? What would this be if payment's happening at period 3? William says 2. I need at least 5 people to give me the answer. This should be super quick and easy. If payment is at period 3, when is our present value? All right? When is our present value? Walid says 2. Bianca, Brandon, Marianne, Vanessa, Yusra, Vince. What do we got? What do we got? What are we putting here? Marianne says 2. One more person for fun. Exactly. That's amazing. Okay. So then I'm going to throw at you one last little joke. So if this is 8, okay, what is this? Somebody tell me. If this is 8, what is this? Last question. Okay, 9. Amazing. All right. Super good. You guys are like almost pros. That's so cool. Now the last part is going to take maybe 1 minute to cover. It's simply the idea of, okay, sure, on an exam, now I know what to look for. I know that I need to look for whether the payments are going to happen forever or are they going to happen for a specific amount of time. And once I do that, if they're happening for a specific amount of time, I'm going to ask myself whether these payments are happening at the beginning of each period or at the end of each period. Then, regardless of what scenario I'm dealing with, I need to figure out whether these payments are growing or whether these payments are going to stay the same. Once you know that, okay, you know what formula to use, but what are the inputs that we need? So let's take a quick deep dive into the inputs that we need in such a time value of money question. So if you were keen enough to look at every single formula, this one, this one, this one, this one, this one, this one, and this one, you would notice that at the very end, there's only quite literally, I guess, maybe 4 things that you need to look for in a question. And we're going to define those. Those 4 things that you need to look at, these are the only things that you need to find or derive for in a time value of money question is payment. Okay. Notice how that's gone. K, that's gone. G, that's gone. N, and that's it. You only need to look for 4 things on an exam question: payment, K, N, and G. And G might not even be there. Sometimes you don't even have a question that deals with G. So now you're empowered to literally know exactly what to look for on an exam. You don't need to look for the size of the earth. You don't need to look for anything else. G is the growth rate, right? N for number of years, K for the interest rate, G for the growth rate, and then payment, PMT, for payment. These are the only 4 things that you need to look for. Nothing else. There's like nothing else I need to look for, okay? Sometimes questions will give you only, for example, 3 of these, okay? And they're going to ask you to solve for the other one. That could happen, but you now know that you only need to look for 4 things. Once again, no pun intended. That's super, super duper important. All right, so when you see and when you prepare for questions like these on an exam, you should not be lost, right? At the end of the day, the first thing that you want to do is highlight important pieces of the question. Then figure out what formula you need to use in this question. Then 3, literally, I do this to this day. Write down payment on your paper, K on your paper, G on your paper, and N on your paper. Write them down and then look for them in your question. Once you've written all of them down, all you got to do now is plug them in within your formula. At the very least, that's the minimum that you should be doing for every single question. After that, if it didn't give you the correct answer, then you get to kind of finagle it a little bit, play with it. But it's very rare that you get to that point. Okay? Also, always draw a timeline, super helpful. So that said, now we can jump in some exam-like TVM types of questions. All right. Now ask your questions now about this, or forever hold your peace. Not really, just send me a message on Messenger and I'll answer whatever you got. So let's get it. Let's do it. Now let's get into it. I'm just gonna set up my doc. There you go. Okay, so question 1. Question numéro 1. Question ichi in Japanese. So you want to deposit your money, okay, in a saving account, and Bank A offers you 3% interest compounded semi-annually, and Bank B offers 2.7% interest compounded daily. Which bank do you choose to deposit your money in? Now, what we're going to do for this question is that we're going to do it together. You're going to see how do I try to solve questions and what's my game plan. Hopefully, you could follow along that game plan right now, and also use that game plan when practicing for questions alike on your own. So the first thing I'd like to do is I like to highlight pieces of information that I believe may be useful. In this case, we have 2 scenarios, right? We have Bank A, okay? So we have Bank A and we have Bank B. So already there, we know that we're dealing with 2 different options, i.e. alternatives, right? Option A, option B. Now, these 2 options differ. How do they differ? Well, one of them offers you 3%, okay, interest rate. That's cool. That's awesome. And the other offers you 2.7% interest rate. That's not bad, pretty dope. However, they differ in their compounding frequency. So we could take this and we could say, you know what? One is compounded semi-annually, which is option A, and the other is compounded daily, which is option B. And now we want to figure out, well, what option do we select? Now, obviously, we don't use the flowchart here. We're not dealing with a set of payments. We're not dealing with any cash flows. We're not asking you to solve for the present value and or the future value of anything. What we are asking you is to figure out, well, which investment is the best, okay? So once again, the best way to go about a question like this, you don't even need to use a formula. You could use logic, and we're going to try to attempt that together. So let's look at Bank A's option. All right, we're going to look at Bank A's option, and I guess we can do this. Will this work? It does work. Amazing. It's cool. So let's look at Bank A's option. So Bank A, once again, is telling you we're offering you 3%, okay, per year, but this is going to be compounded semi-annually. All right, that's what they're telling you, compounded semi-annually. Now, on an exam, you could just plug this in within the formula. But what we're going to do now is we're going to visualize the formula, we're going to make sense of it, and then we're going to plug it in within the formula. That's how I practice problems when I took the class. I would always go above and beyond what is requested from the question because I want to visualize it, I want to understand it, and I don't want to deal with the classic, well, I didn't see this question in my practice questions. Well, if you understand stuff, you don't care whether you saw it or not because you understand the material. You'll be able to kind of like show resiliency and get through it. En français, we say that's a débrouillardise. So if we were to visualize this, let's visualize Bank A's option. So we'll write it down right here. This is Bank A. All right, so Bank A, what they're telling you is that they're going to offer you 3% semi-annually. So 3% here, 3% here, 3% here, and 3% here. Notice how essentially this is 3 months, This is 6 months, 9 months, and then we have 1 year. So I feel like the timeline should be pretty clear. That's what they're telling you. Now, obviously, it's not going to be 3% that you're going to get every 6 months. No, you're going to get half of that. Okay, you're going to get, okay, interest rate per 6 months, i.e. semi-annually, will be equal to 3% divided by 2, i.e. 1.5%. So here, you're actually going to be getting 1.5%, 1.5%, 1.5%, and 1.5%. Okay? So that's awesome. Now we have that part. So essentially, this is telling you that if you had money to invest, right, it would be compounded at this amount. It would make 1.5%. Then you're going to take that principal plus interest, and you're going to take that, and you're going to compound it with 1.5%. And that's going to give you a new, it's going to give you a bigger amount, right? Because you're compounding interest. So what we could do now is we could do, and I'm sorry that it's ugly, 1.015 to the power of 2. And that's going to give us an amount. Minus 1, that's going to give us an amount. Can somebody in the chat tell me what does 1.015 to the power of 2 minus 1? Can somebody tell me what does that give you? What does that give you? Yeah, thank you. Exactly. So that gives you effective annual rate of 0.03025. Okay? In other words, this gives you 3.025%. Okay, so I'm going to visualize bank B's option. And from there, you're going to tell me what's up with it. So here we're getting 2.7% interest per year, but we know that this is compounded daily. Okay, it's compounded daily. Oh, thank you. Yeah, I kind of went with what you said, but thank you for the correction. Okay, so that's compounded daily. So essentially, we're telling you that every single day, a portion of 2.7% will be compounded. Okay, every single day. Somebody tell me, what would be our effective annual rate if we were to consider that? What would be our effective annual rate? So what you would do is 1 plus the rate divided by 365 to the power of this, to the power of 365. What would be your effective annual rate? As somebody other than Waleed will give me bank B's option. Somebody other than Waleed. Okay? Somebody other than Waleed, I want you to give me the answer for bank B. How much would be your effective annual rate? What would be your total return in a year if you were to have 2.7% compounded daily? Once again, having something compounded daily is simply taking the rate they're giving you in the question, dividing it by the total number of compounding periods, and then taking that amount to the power, okay, of the number of compounding periods, and that's going to give you your answer. All right? We're literally telling you, hey, if you were to essentially compound that amount to the number of times that was provided, so either daily, monthly, yearly, blah, 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 what would be your total return at the end? That's what we're asking you. Okay? So can somebody tell me, what is the effective annual rate of Bank B? What is the effective annual rate of Bank B? What do you guys got? This has been on exams. It's super easy. It takes 2 seconds to do. And that I hope you have questions. You know, if you have a question, let me know, because I'll help you out. You know, I'll be more than happy to help. So what is Bank B's option? What is the effective annual rate of Bank B? Because somebody to give it a shot. Bianca, Brandon, Jessica, Vanessa, Vince, Yusra, William. What do y'all got? What are we supposed to do here? Yeah, it's in the question. The bank offers 2.7% interest, okay? And that interest is compounded daily, all right? Such that, what is your answer? I'll give you guys, okay. That's amazing, William. Thank you so much. Exactly. You would get the very fair amount of 0.0273, essentially, whoops, 2.73%. Okay, so now let me ask you all this. William, what's up? What's good?
Quick question, Ismail. So let's say that in the question they mention it's the effective rate, so then we don't have to do the calculation, right?
Exactly. So that's an amazing question, actually, William. If in the question they tell you, hey, this is the effective rate, well, in that case, you already have the effective rate. You already have the rate that includes the compounding. You don't need to do anything to it if you're trying to compare an effective rate to another. Okay, that's an amazing question. In this case, they told you, hey, here are just rates. With that, they didn't tell you that's the effective rate. They also told you that it's compounded at a certain volume. So with that, you need to make sure to compare both of them with both their effective annual rate, because it's the easiest way to go about it. But that's a very, very good question, William. Okay. Any other questions for question 1? Are we good? I need everybody to tell me, if you see this on an exam, do you know exactly what to do? And do you feel confident that she'll get the right answer? Quick yes or no in the chat. If I see 1 or 2, that's okay. We'll move on to the next. If we see this on an exam, are we good? Are we happy? Are we fulfilled? Yeah, exactly. That's amazing. Actually, Walid, I love that. So yeah, the first part, yes, we choose Bank A, obviously, because Bank A is bigger than Bank B. Now, unless you want to lose money, you'd go with Bank B. But so yeah, Walid, first part is highlighting the important parts, then finding the effective rate, and then comparing them. 3 steps of this question. And you don't need to find F here, right? You don't need to, because you have everything that you need. It's very rare that you need to find F. I've actually never seen a question like that myself in past exams and or in the class when I took it. Usually you may need to take a rate to another. It would be very complex because it's going to be a fraction. And anyway, it would be very weird to kind of find just the exponent. I've never seen that. I could be wrong though, but I've never seen that. So I wouldn't worry about that too much. I feel like that would be a low blow if they would go so far. But yeah, okay, I feel like we're okay with this one, which is good. So we can move to question numéro 2. So this one is also a kind of an introductory question, kind of straightforward. And then after that, it kind of ramps up very quickly. So Pfizer offers a perpetuity of $4,758 per year, with the first payment paid in 3 years. If your opportunity cost is 20% compounded annually, the present value of the perpetuity is what? So this is an awesome question to kind of just try out the fundamentals before we go into the harder stuff. So we'll do it once again together, and we'll highlight the key pieces of how I would do it on an exam, okay? So the first part is highlighting important information. In this case, they're telling you, hey, we're dealing with a perpetuity. Hey, this is $4,758 per year that you should expect. The first payment is happening in 3 years. It's pretty solid. Your opportunity cost is 20%, and it's compounded annually, which is essentially telling you that this is your effective annual rate. And we're asking you, what is the present value of this perpetuity? Okay, so already there, we highlighted all the information that, there's nothing else. A really good trick to do that I usually do is I just highlight all the numbers. If the number is there in the question, you probably need to use it. Especially in time value of money questions, it's really hard to give you too many numbers. It's very rare that that's going to be the case. Maybe in chapter like, I believe it's 12, no, chapter like 13 or 14, when you're talking about cash flow estimation and capital budgeting, stuff of that nature. But here, typically all the numbers you need to use, okay? So now, once again, if you guys remember, the first step, I guess we'll write it here, step 1, sense check, so flowchart. So the flowchart sense check. There are 3 things that we want to look for, okay? Number 1, are these payments happening for a defined amount of time, or are they happening in perpetuity? Could somebody in the chat tell me, are they happening for a defined amount of time, or are they happening in perpetuity? Could somebody in the chat please tell me, defined or perpetuity? I need everybody to give it a shot. Willie says defined. Are these payments happening for a defined amount of time, or are these payments happening forever? Number 1, the first sense check. Are they happening for a defined amount of time, or are they happening forever? William says forever. Yeah. So here, payments are occurring forever. Okay. By the way, if the question says perpetuity, obviously we're going to deal with a perpetuity, right? If they're telling you a payment is going to last in perpetuity, then we're dealing with a perpetual set of cash flows. So payments are occurring forever. Now, beginning or end of period doesn't matter because we're dealing with a perpetuity. So the second sense check, because we're dealing with a perpetuity, it does not matter. We don't care. But the third sense check, which is whether these payments are growing or whether these payments are going to stay the same, is important. Let me ask you all this in the chat. Are our payments staying the same, or are they growing? Tell me. Are these payments going to stay the same, or are they growing? Are they staying the same, or are they growing? By reading the question, are these payments the same every single year, or are they growing? Growing like, by like $10 a year type of thing. So Willie says growing, William says it's the same. I need a tiebreaker. Are these payments growing, or are they staying the same every single year? Exactly. Payments are going to stay the same. Now, I'm sure that Brandon and Waleed, you guys know exactly what you're doing. And it's because it's more sort of wording. Okay, I feel like it's more sort of wording that I'm giving you that's not helping. So that's why we're going to try to essentially draw this into a timeline for it to make even more sense, because you guys obviously know what you're doing. So check this out. So step 2, when I have questions like this, is always to draw, I guess, to draw a timeline. It could be step 3 as well. But. So step 2 is to draw a timeline. Even a seasoned vet like myself, I got to use a timeline. So what we're going to do here is we're going to kind of draw a timeline together. And we're going to say that T0 is today, T1 is year 1, T2 year 2, T3 year 3, T4 year 4, T5 year 5, and so on and so forth. In this question, we're going to try to put what the question is telling us onto a timeline. So I'm going to ask y'all, when should we put this amount of 4,758? They're telling us that 4,758 is happening every year, okay? But the first payment will happen in 3 years. So where should I place it? Where should it be placed, this famous amount? Thank you so much. It should be placed at T3. And let me just put these all as numbers. Well, it's currency, I guess. Okay, so it's happening forever, starting year 3. All right. So this means that every single year, forever, we're going to have $4,758. Okay. So now, Brandon and Waleed, if I were to ask you, are these payments the same every single year, or are these payments growing by a factor every single year? Could you tell me? Do you see it? Does it make more sense? Like now, why it's not growing? Like Waleed, does it make sense? Brandon, do you like? Does it work? Like, did that help? Like visualizing why it's the same? Yeah. Okay. Cool. I'm gonna assume that's a yes. So now we're able to draw our timeline. All right. So that's super solid. We did that. See Excel. Okay. Now let's do step 3. I'm really taking it step by step. It's defining our key variables. Defining our key variables. I don't know why that took me so much time just to type, but it happens sometimes, I guess. So we have A. Okay. By the way, when you do your sense check, therefore, we're dealing with a normal perpetuity. So I want it to be obvious that we're for sure dealing with a normal perpetuity. But what I'd like to say is, can somebody tell me, if we're dealing with a normal perpetuity, what formula are we using? Somebody tell me in the chat, write it in the chat. What formula are we using? There you go. So we're dealing with the very classic payment over K. All right, so that's the formula that we're dealing with. And I don't know why it's like this. There you go. So that's the formula that we're dealing with. We're dealing with PV is equal to payment over K. So in this case, we're literally only looking for 2 variables, all right? Because the formula only has 2 variables to look for. We're looking for K and we're looking for payment. Somebody tell me, what the heck is our payment and what the heck is our K? Somebody be so nice and do that for me. Yeah, 100%. Our payment is 4,758. And in our K, what is our K? Exactly, 20%. Okay, so then, now we can start computing stuff. Step 4, solving our perpetuity. Okay, so now step 4 is to solve our perpetuity. Can somebody tell me, what is the present value of this perpetuity? What is the present value of this perpetuity? Somebody write it in the chat. What is the present value of this perpetuity? Okay, cool. So our present value is equal to 23,790. Now let me ask y'all this. Is our present value the answer? Are we done? Did we finish the question? Let me ask you this. Are we done? Are we done with the question? Did we finish? Yes or no? Are we done with the question? Well, of course not. Remember, I tricked you guys a little bit. We need to discount it by 3 years. Why? Because the value that we got, you guys remember this idea of the present value is that the present value will always give you the period before, the period removed before, such that the amount that we got right here right? This amount right here is actually 23,790. But it's still not at T0, okay? It's still not at T0, all right? And for that reason, we need to discount that amount, okay? So if I were to actually show you what this looks like, you would have this right here, the equation. Oops. Sorry about that. Having a look. There you go. So remember before when we were explaining the formula of the perpetuity, we said that PV, right? PVN is equal to payment n plus 1 to the power of k. So in this case, if we know our payment is at year 3, we're getting our PV at year 2. So that's definitely not our final answer because we want to solve for PV at 0. So can somebody tell me, how would we solve for PV at 0? Well, you would discount it, okay? Now let me ask y'all, if we got our answer at PV2, how many years do we need to discount this for? Could somebody tell me in the chat, how many years do we need to discount this for? But how many years? Waleed says 3 years. The answer is either 2, 3, 4. How many years do we need to discount this for? 2, 3, or 4? I need everybody to give it a shot though. Like, how many years do we need to discount this for? What am I going to put in the little box? Exactly, I'd put 2. We need to discount this for 2 years because what we got from our formula was PV2, okay? So it wouldn't make sense to discount it for 3 years, all right? So this is a very important notion to remember. The reason why we use a timeline and the reason why we use the formula to the T, and we make sure our notations are correct, is because the devil really lies in the details. You want to make sure to visualize where you're going with your answers. How is that being represented through your formulas and your timeline? And with that, you'll know exactly what to do because 3 and 2 is a very different exponent. Now, let me ask you all this. If you plug this stuff in, what would be your present value? What do you get? What do you get as your present value? No. Waleed, maybe you want to try it out one more time. Maybe you want to try it out one more time. Remember that PV2, okay? PV2 is equal to 23,790. Now, if we were to put that, all right, if we were to put that right here, I'll plug it in for y'all. If we were to put that right here, we would have a different number. We would have this, okay, divided by 1. Power of 2. All right. So Waleed says 16,520.83. What about Bianca and William? What do y'all think? What is the answer? Bianca and William. What do y'all got? Amazing. I'm very proud of all of you. Yeah, so that's the answer. 100%. So let me ask all this. If you see this on an exam, how do you feel? Did you understand what we did here? This is, once again, more of an introductory question. It's still not among the most complicated ones. I would say this is probably like easy to moderate. This would be an easy to moderate question if it were to be on the exam. But I want to know do you understand the topics at play? Do you understand the methodology that we used, which is always number 1, highlight, number 2, flowchart, number 3, timeline, I guess number 4, define key variables, and then number 5, you start, solving for stuff. Yeah, so William, I totally agree. Now, let me ask you this then. If you use the timeline, right, and you know that the present value, because of the formula, will always be 1 period removed, all right? So you know that your payments start here, okay? And you know that your present value will be 1 period before. So it has to be at year 2. But because you're at year 2, obviously you're going to discount not by 3, but by 2 years, because you always discount by the position on your timeline. And if that doesn't work, you could always use the formula. The formula really makes it clear to you. Okay, I'm at payment 3. If I look at my formula, it's bringing me at PV2. PV2, no S, PV0. All right, well, that little notation, that 2, is what's going to be my N. All right, the notation will always be your N. Never forget that. Notation will always be your N. Your position within the timeline will always be your N. Before we move on, we have time for maybe 1 question and a half together. 1 more question together. How are we feeling? Are we okay? Are we doing all right? How are we doing? Quick little sense check. How are we feeling? Are we good? Are we not good? Genki desu ka? Daijoubu da yo. Okay, perfect. All right. That was a very poor attempt to speak in Japanese. All right, so let's do it. Question 3. Let's do it. Let's do it. Let's do it. That. Just give me a second. I'm just going to format this super quick. So in the meantime, you could read the question. All righty. All right, this one's kind of crazy. Okay. So let's read this one together. We're really going to try to go through it as much as we can. And I'm going to probe you a little bit as we go through it. Okay, we're going to follow the same steps. So you are going to pay, and I guess we'll do it exam pace, just for you to see how I would want you to do it. So we're going to highlight as we go through it. All right, so you're going to pay $800, all right, into an account. That's super important. So we're paying $800 into an account. That's solid. And it's happening at the beginning of each of 20 years. Okay, so at the beginning is pretty important. And then we're saying that this is happening for 20 years. Okay, and the first payment is at T0. The account will then be left to compound for an additional 20 years. Okay, so it's going to be left to compound. So that same account is going to be left to compound for an additional 20 years. Okay, shoot, it's interesting. And then at the end of the 41st year, okay, at the end of the 41st year, all right, you will begin receiving a perpetuity from the account. Okay, cool. That same account, that's interesting. And if the account pays 14%, okay, that's interesting. How much each year will you receive from the perpetuity? Okay, so how much, that's important. How much money am I going to receive each year? Okay, it's not bad. I guess I'll highlight this in another color. So how much money will I receive each year? We'll put that in blue. Will you receive from the perpetuity? Okay, so it seems like we're dealing with the same account. Interesting. Now, obviously, if you see this on an exam, you're probably like, what the hell am I even reading, right? This is a lot of stuff. And how I would look at it, especially with a question like this, I believe the first step in a question like this is really to maybe draw it on a timeline. I believe that would be the first thing. Maybe you could have like a small, nervous conversation with yourself at the beginning to kind of pinpoint that, okay, it seems like we have a lot of components of a lot of different sorts of formulas, right? The first section of the question is talking about the beginning of the period. When and where do we hear about payments happening at the beginning of a period? Would an annuity do? Okay, so that's one bucket. Interesting. Then another bucket of the question, another segment of the question is telling you, well, we're going to leave money just to be compounded. So just something to be compounding interest for an amount of time. Okay, well, that's another section. Then if we go at the before last sentence, it's telling you, okay, well, at the end of the 41st year, you're going to start to receive a perpetuity. So it seems like if we are just kind of trying to highlight a few pieces of the question, it seems like we're dealing with three buckets. So three segments. Okay, it seems like we're dealing with three segments. The first one seems to be dealing with an annuity due. The second one seems to be dealing with just compounding interest. Then the third one seems to be dealing with a perpetuity. Okay, so listen, is this telling you what to do yet? Maybe not, but it is putting you in the right direction. This is how I would brainstorm with myself on this sort of question. You want to think, okay, so three segments, one segment's an annuity due, the second's a compounding interest, and the third one's a perpetuity. Okay, cool, not too bad. From there, I would probably go with step one, drawing our timeline, trying to visualize what we're kind of dealing with here, okay? So let's go do that. Let's go draw this timeline. Now let's zoom in here, zoom out here. And now I'm going to ask you to interact in just a bit, so don't you worry. Okay, so let's draw our timeline. We'll make it a little bit better. So let's say T1 is this. And we'll skip a few years. We'll go all the way to T18. Go to T19. Oops. Go to T equals 20, I guess. I'll add one more just for fun. Okay, so we have a little timeline here. All right, so we have a little proxy timeline. What I tried to do is I tried to highlight a little bit of the important pieces, right? So we have T0, we have year 20, we have year 41, we have year 21. Like we have a few numbers, and with that, we're gonna try to like pinpoint a few pieces. Okay, so let's begin with the first segment. Can somebody tell me where would I put this $800? They're telling you that you're going to pay $800 into an account. Where would I put that within our timeline? Can somebody tell me? Where would I put that within our timeline? Where would that be? That $800. When and where? Okay, so the first one, yeah, I like that, is at $800. Okay. Now let me ask you this: when would our last $800 be? If they're telling you that it's happening at the beginning of each of 20 years, okay, when would the last one be? Obviously, we're going to have one here. Obviously, we're going to have one here. Obviously, we're going to have one here. But this is where the nuance kind of lies, right? I need everybody to give it a shot. Is it T19 or T20? William says T19. Bianca says T20. Okay. I need more people to give it a shot. Okay. More people to give it a shot. When is our last $800 going to be? William says 19. Bianca says 20. Bianca says 19. Okay. What about Waleed? What do you got? What do you got? More people. What's up? where are we at? Okay, you know what? I won't waste our time. So we got 10 minutes. Well, he says 21. Okay, well, let's read the question together once again. You're going to pay $800 into an account at the beginning of each of 20 years. What does this mean? This means that for 20 years, you are going to pay $800 into an account. That means that 20 times you are going to pay $800 into an account. So for sure, 21, it can't be because you're going to pay 20 times. Okay. But now the nuance lies in when are we starting those payments? Well, we said we're starting them at the beginning. So today at t equals 0. So if you started, as Bianca said, amazing, so good. If you started at t equals 0, well then you could literally use your fingers. Okay, 0, so it happened at t equals 0. So we have 0, 1, 2, 3, all the way to the 20th one, which is going to happen at t19. At t19, you would have made your last payment of those 20 payments. So $800 would actually stop at t equals 19. So that's a nuance. You really want to be able to visualize that within your timeline. It's really good to have that intuition, okay? Then we're telling you that for the next 20 periods, okay? For the next 20 periods, you are going to be essentially compounding interest, all right? So for the next 20 periods, you're going to be compounding interest all the way, all right? All the way to t equals 40. Now, one thing that I'd like to note with everybody here, that for sure, I guess we could write it here. For sure, you're going to be compounding interest, and I'll put them in yellow, all the way to this date, right? For 20 additional years, you're going to be compounding interest, okay? So for 20 additional years, you'll be compounding interest, such that you're going to get an amount called FV40. I think so far so good, right? The idea of compounding interest is pretty straightforward. You know, it's just your compounding interest, pretty simple, okay? But now this idea of the third segment, which is our perpetuity. So our perpetuity, they're telling us, yo, at the end of the 31st year, you're going to receive I guess, yeah, whatever. You're going to receive a payment, okay? You're going to receive a payment at period 41. This is very interesting because this payment, because this payment is a portion, it doesn't stop at year 39. William, that's an amazing question. The reason why it doesn't stop at year 39 is because with the formula of a normal annuity, you got to remember what, actually I can just show it to you. Remember what our formula for our growing annuity is that you're adding a compounding interest at the end. Because you're adding a compounding interest at the end, it's like if that last payment that you received is going to be compounded for an additional period, such that it's going to bring you your future value at FV20. Okay, that's like a very, like, I wouldn't say, it's like a nuance. It's like really the devil does lie in detail here. Okay, but now we are at the last portion where we know, if I go back on the screen, we know that, okay, at the end of the 41st year, you will begin receiving a perpetuity from the account. So we know that this is what we're solving for, by the way, and we know that that's going to occur right here. Okay, so far so good. We were able to define all of the different portions of this question. You just want to be able to visualize it. That's really the first, like the nuance of what we're doing. So if we were to like maybe color code it, we would say, okay, T0 all the way to T19 is one portion of the question. And then T20 all the way to T40 is another portion of the question. And then we would say that T41 all the way to infinity is another portion of the question. So we could say that this is part C, this is part A, and this is part B. Okay, so that's kind of like the timeline that you want to be able to have. Obviously, this is on an Excel, it's not beautiful and perfect, but you want to have that in mind. So, like any strong student, you would say, well, okay, there's a lot of information, but what I'll do is, because I know we have 3 segments, I could at least try to plug these things in within my formula. And obviously, I'm looking for some sort of money in the future. So for sure, I'm seeking some sort of future value. So the first step, or I guess the second step, would be to solve our annuity. Our annuity due. And in this case, what I'll ask y'all is, you're going to use the formula, and I guess I won't screenshot it. I guess I will. You're going to use the formula, I guess, and you're going to try to tell what the answer is, okay, with the information provided. I'll even give you I'll just put the formula here, and I will ask you to solve for your annuity due. Oh, sorry about that. Give me a sec. There you go. So this is a formula of a normal annuity. That's the formula for future value of an annuity due. I'm going to ask you to use this formula to tell me what would be the future value of this annuity due that we have in this question. And as we said before, you always define your payment, you always define your K, your N. In this case, that's all that we need. So could somebody tell me, what is our payment? Just really quickly, we'll make it fun. And then after that, you just got to plug it in within your formula. But you'd be surprised. For some reason, plugging stuff in within the formula is hard. And it tends to be like the root of all evil. So what is our K? What is our K? What is our K? Waleed or William, what do you got? What is our K? 14%. Amazing. What is our N? What is our N? Somebody tell me, please. Bianca, you got this. I know Bianca has the answer. Bianca, what is our N? What is our N? I know you got it. I know you got it. Exactly. Beautiful. Amazing. Great stuff. Okay, so we have everything that we need. With that, can I please ask y'all to tell me, what is our future value 20? And I guess I'm going to ask William to tell me what's our future. Actually, no, Waleed. What is your future value 20? Everybody could write in the chat, but I definitely want Waleed to give it a shot. So what is our future value 20? If you use the formula. And after that, I'll go through it quick because we're almost out of time, but super fun stuff. We're solving, well, what are we solving for, right? What is the, once again, when we're dealing, and this is a really important, like super strong key takeaway. With time value of money questions, especially with time value of money formulas, once again, we only have to look for 4 variables once we have our formula, right? Payment, K, N. And if G, if there is one, we would use that. In this case, we're dealing with a annuity due, and we're looking for the future value of this annuity due. We have all of the inputs. We have payment, we have N, and we have K. All that we have to do is literally just plug it into the puzzle, and it's going to give us an amount. We're really throwing stuff into the wall, and it's going to give us something. But you don't need I, right? There's no I in this thing. It's 1. It's 1 plus K to the power of N, right? So 1 plus K. Yes. So what is future value 20? What is future value 20? I'll give you guys like 20 seconds. That's pretty funny. To give it a shot. And after that, we'll call it a quits. And I'll go through it step by step. Thank you so much, William. That's amazing. Perfect. So that's our value right here. That's going to be our value that we have right here, future value 20. Okay, that's super solid. But once you have your future value 20, what are we doing? We're letting that amount compound, essentially accrue interest for an additional 20 years. So how would we do that? We would write that down as simply being future value 20 times 1 plus k to the power of 20. That's for step 2. Now we're essentially doing B, which is compounding interest, right? So once you found your future value 20, that amount we said in the question, the account will then be left to compound for an additional 20 years. So could somebody tell me, what is this amount? If we were to do FV20 times 1 plus k to the power of 20. William, you already have the answer. Could you tell me what that would be? If you just do that quick math, I'm sure it's still like on your calculator. What would that give you? For some reason my stuff stopped working, but yeah, so it's essentially 1.14 million. For some reason there you go. But yeah, William, you did great. Exactly. So that's exactly the answer. You could round it up to this. Okay. So then we have our future value at 40. Could somebody in the chat remind me what is the formula for a perpetuity? Could somebody in the chat please remind me what is the formula for a perpetuity? We said that it was PV0 is equal to payment 1 over k. In other words, we could say that a perpetuity, yeah, what's up, William?
Quick question. What's the 1 million answer for again? Like the F
Oh yeah, no
the
problem.
compounding.
Yeah, so in the question, right, it kind of follows a timeline. In the question, it says, okay, you have a set of money, 800 bucks, that you're gonna essentially pay every single year at the beginning of the year, right? And that's gonna give you obviously a lot of money 20 years from now. And we noticed that, okay, well, if we were to do that for 20 years, we actually end up getting 83,000 some dollars, right? At this amount here, at year 20, okay? Then that $83,000 that we have, we're gonna let it compound for an additional 20 years, such that you're gonna have a lot of money at T40 in essentially 40 years from now. And with that, what you're gonna do is you're gonna receive a perpetuity from that, okay? You're gonna receive a perpetuity from that amount, from that same account. You're gonna take that amount and they're gonna allocate essentially a perpetuity from that, okay? But what's interesting is if we go back here, what's really interesting is that we get, no problem, we get PV N, okay, is equal to payment N plus 1 to the power of K. So what's really interesting is that if you understand that, you could kind of, and obviously the more questions you do, the more you'll see us using this like tactic. But in this case, if you understand that, you can say, okay, well, if payment is at period 41 in this question for a perpetuity, then technically PV that we would need is the one at year 40. But what's awesome is that, do we have something at year 40? Do we have something here at year 40 by any chance? Would that be possible that we have something at year 40? Do we have something right here at year 40? Do we, yes or no? Yes, we do. We have the future value at year 40. And obviously, future value at year 40 is the same thing as present value at year 40. At year 40, your amount of money will be exactly what you have at year 40. You know, your future, what future value means is like literally we're telling you, hey, how much money will you have 40 years from now? And then that person 40 years from now will say, well, that's the amount of money I have today in the present 40 years from now. So it's really important to understand that PV40 is equal to FV40. It's the same thing, okay? Super important to understand. So with that said, now what we could do is we could solve for payment 41. We could solve for the perpetuity. So payment 41 over 0.14 is equal to that FV40 that we got below, that 1.1 something million. So could somebody tell me, by using this, could somebody tell me what is our payment 41? Could somebody tell me what is our payment that's happening in perpetuity, i.e. what is the answer? So we have payment 41 over 0.14 is equal to FV40. In other words, 1.140912.212. What would that give us? Hallelujah. I love to see it. Exactly. It would be 159,727.70. And you could round it to the nearest 1,000. That would be 160,000. All right. That's how you solve a large question. Now, obviously, because we spend so much time kind of talking about theory and we're running slow on time and I'm using my mouse to solve the question with you, it's not the smoothest process. But I do hope that we were able to kind of like break this question down into some sort of bite-sized pieces that you could maybe think about afterwards or review after this session. But before I kind of wrap up what we talked about and kind of give you some guidance and some guidelines for what we could do from now on, I want to know, do we have any questions about this exercise that we did? Is there like anything that you're like, not too sure about before we move on? Like if you see something like this on the exam, do you know what to do? Do you feel comfortable? Were there any pieces of this question that you're not too sure about? Because this is kind of like the structure of a complex question on an exam, okay? This is like a medium, slightly hard, medium, more of a medium. What's up? What's good, William?
So the question mentioned at the end of the 41st year, would that be like the beginning of the 42nd year?
Yeah, but that's if you were dealing with annuity due. For you, because it said, hey, at the end of the 41st year, that only tells you, hey, this is at the 41st year and we're dealing with a perpetuity, okay? So with a perpetuity, by the way, as I said before, it's a very important nuance. You don't care if it happens at the end or at the beginning of a year. In this case, it told you, yo, at the end of the 41st year, we have a perpetuity. So for all matters for you, you just plug it in as the exact number for payment. And also, like you already have the value at FV40, you want to use it to your advantage for the perpetuity, right?
Yeah.
So it kind of like it mixes well together.
Okay. Got it. Thanks.
No problem. Any other questions before we wrap it up and I give you additional points of advice, ideas and stuff? Or are we good? I'll give you. Okay. Well, if nobody says anything, I believe we're good. Okay. So what I'd like to say is that this document has another question and another question, another question, and another question, and another question. Like these are questions that are a little bit harder. Okay. Number 4 is easy. Number 5 requires quite a lot of work. Number 6 requires some work. Number 7 is interesting, and then number 8 is easy. I recommend that you guys do them tonight. Send me some questions on Messenger, and I'll be more than happy to help you. If you appreciated tonight's lesson, well, it was a pleasure, and I'm really here to help you as much as I can. It doesn't make sense that this class seems to be one that people fail. And for me, that doesn't make sense, especially when you have all the different tools to your disposal. Like I'm here to help you at all times. You have all of my question banks, you have all of my recordings, you have my YouTube, you have everything in the world to do correct. And that's for free. If you want to join my next weeklies, which will be next Thursday, 5 to 7 p.m., And then my crash courses, which will be on the week of the exam from 5 to 9 p.m. on Wednesday and Thursday. So that's 2 sessions of 4 hours each, in which we're going to be doing 15 questions uninterrupted, like hardcore exam mode, and you're going to have some really cool exposure. Then you're more than welcome to do so. Let me know. I'll tell you how much it costs. It's a good vibe. And if anything, the records are going to be posted as well. So no matter what, you will have access. But regardless, oh, by the way, Jessica, very good question. The stuff that's going to be covered the most on the exam will be TVM, then portfolio theory, and then bond valuation, equity valuation will kind of be like sprinkled around the exam. But really the most complicated chapters to really understand would be TVM and portfolio theory. Then bond and equity valuation is a subset of TVM. It's really just cash flows, but just with a different twist, but it's the same idea. Bonds are a normal annuity, by the way. And then equity valuation is a perpetuity, typically. So they're very, very easy as soon as you understand the foundation of TVM. But if you want more questions, this is in our Facebook chat. If you need some help with some questions, you can message me. If you want to do some one-on-one tutoring, we can. If you want to join the weeklies, you can. If you want to join the crash courses, you can. I'm here to help you. If you do this every day and you work hard, there's literally no reason why you don't get like an 80 or 90 on the exam. It would be really funny if like all of you guys end up getting like a 90, right? Your teacher's gonna be so confused, and I think it's possible. So that said, I'm gonna go eat, go play some basketball, and I'll have my phone on me if you guys wanna send me a text and kind of answer your questions, okay? So hopefully this was helpful. The recording's gonna be posted in a bit. Yeah, you guys were awesome, and we'll talk soon, hopefully next week. Ciao, ciao, ciao.